Hi, and welcome to the Down to Finance podcast by Future Finance Group. We recently hosted our first time investor seminar, bringing together experts from lending, accounting, property, planning, and more. Across the night, there were plenty of sharp insights and real-world guidance, so we're distilling some of the best moments for you here. Today's feature is Daniel Ward from BMT Tax Depreciation. Daniel explained what depreciation actually is, how schedules work, and why depreciation can significantly improve cash flow for investors. Without any further ado, here's Daniel.
I won't stand in front. Yes, so I've been working with BMT for about 14 years. I'm a site inspector, so I travel around and visit the various residential and commercial properties and ferret around trying to find the depreciable assets out there, document them so that it's tax office compliant when we put our figures together. I'm going to talk to you a bit about what depreciation is. So anyone who works from home on a computer can claim depreciation on their computer. It's the wear and tear of the computer, and you claim that over time. If you're a tradie, you've got tools, you've got a van, you're writing that off over time. That's depreciation. It's an income-producing asset. But we're talking about investment properties, and that's where depreciation comes in and can be very powerful in terms of generating that cash flow positivity as you go forward in your investment journey. Before we go on, I just want to point out that it's often the second largest deduction for a property investor after the interest on your mortgage. So utilising tax depreciation can really have a big impact. Just go on to what a quantity surveyor is. So why am I here? It's because I work for a quantity surveyor. And the tax office recognises quantity surveyors' cost estimations when it comes to buildings. Quantity surveyors traditionally will work out how many bricks and beams, how much concrete steel goes into a construction, and then costs it out to plan a project. But we work at the post-construction stage. So when the building's been done, we go in there and work out how much it cost to build when it was built. So whether that was last year, 10 years ago, 50 years ago, or whenever it was. So the case study we've got here is a new 4-bedroom home. It costs us $820,000 to purchase. The rent's $700 a week. Income per annum, $36,500, and our expenses are just over $50,000. Those expenses at this stage don't include depreciation. They're expenses that come out of your pocket. So things like interest rates, management fees, maintenance and repairs, taxes, those sorts of things. And we're going to take that information to our accountant. We can see already though that we're losing $13,800 just holding that property for the year. It's costing us $265 a week just to maintain that property, keep it in our hands. So we're taking this information to our accountant. So we've got the same figures up the top there, but we get a tax deduction because it's negatively geared. We can offset that against our income. We're using a 37% tax rate as a marginal tax rate there. That's the most common tax rate for a property investor. If you're in a different marginal tax rate, you sort of adjust those figures accordingly. But we get a tax return of we get a tax refund of $5,100, bringing the cost to hold that property right down. So now it's only costing us less than $8,700 or $167 a week. I'll read the figures out because it's probably hard to see at the back, and their impact is a little bit more important. So we're taking along a depreciation schedule with us to our meeting with the accountant. I'm a bit more squishy than the other ones. We're claiming $16,500 in depreciation deductions for that first year on that new property. So that's a non-cash expense that's not coming out of our pockets. So it brings our tax loss up to $30,300, meaning our tax refunds more than double to $11,200. The cost to hold that property for that first year is down to $49 a week. So that's a lot more manageable. And you'll be hoping in the next few years with rental increases and so on that you're going to be cash flow positive going forward. So what can be claimed? How do we break it down? This is important when it comes to talking about brand new properties compared to second-hand properties. Capital works, that's the building structure itself, all those non-removable items, things like windows, doors, kitchen cabinetry, bathroom cabinetry, that if you remove, it'll damage the property. You can claim that at 2.5% per year over 40 years, which is the life of a property. And then you've got the other items, plant and equipment items, Division 40, in a residential setting. Only new items can be claimed that are plant and equipment items. So if you purchase a second-hand property or one that you've lived in, you won't be able to claim these plant and equipment items. They make up roughly about 10 to 15% of the property's value. But in those early years, because you can write them off so quickly, so instead of over 40 years, sometimes 5, 8, 15, or whatever the item is, you can write them off faster and have more deductions in those early years, offsetting some of those costs and improving your cash flow situation. But we'll have a look at those older properties because we shouldn't sniff at them. There's some lovely properties out there. Obviously, some of them are on bigger blocks of land as well. We've got this 3-bedroom house built in 1996. We're claiming on an average $5,200 for the next 13 years. Over the first 5 years, we've got $30,160. A little bit extra there because some renovations have taken place and some new plant and equipment items have been added by the new owner. And you might find that if you do buy a second-hand property, that you are actually having to put in some money to add these plant and equipment items because you have to bring it up to compliance standards. So if we're going to be adding that split system to replace that gas heater, we'll be able to depreciate that as well. So that brings the marginal cost down for you. Renovations, 2/3 of properties that we, 2/3 of investment properties have had some sort of renovation done. And knowing how to utilise renovations as a part of the strategy can set you up for some really big tax advantages later on. Let's go to that next screen there. So we've got, let's say we've got that 1995 built house. It's got a 40-year life. So it's 2025 now, it's 30 years old. So it's got a 40-year life, 30 years gone, we've got 10 years left, that's 25%. Let's assume that it cost $100,000 to build in 1995. Probably more, but it's a nice round figure. That means it's still got $25,000 worth of residual value in that property that you'd be expecting to claim $2,500 over the next 10 years. You can claim that full $25,000 in one financial year, as long as it's income producing before you knock it down. And then after you rebuild, let's say 2 townhouses on that particular property, as long as you retain one of those townhouses, you can sell the other one or live in it. As long as one of those is income producing, you can claim that $25,000 in residual value in that stuff that you're just sending to the tip in one financial year. And also because one of those townhouses is income producing, you've got a new depreciation schedule for that as well. Happy days. This also applies to things like renovations to bathrooms, kitchens and so on. So there's residual value in those items. Just make sure you've got a depreciation schedule in place or a quantity surveyor's been out to at least have a look at it so that you don't just throw the money out with the same skip that's going to the tip. Commercial properties this applies to as well. Often it's the landlord and the business that's running in there that can claim it. So we've got 2 entities there, the holder of the building itself, and then you've got the business owner who's running the business, and they've paid for the fit out, they've paid for the cool rooms or whatever else might be involved in that particular commercial operation. We've got a few examples here, but like we did the Melbourne Eye, we did the Big Banana. All sorts of commercial properties are applicable to this as well. So depending on what your investment strategy is in terms of commercial properties, if you go down that route, there's depreciation deductions there. Some of the frequently asked questions that we get asked, doesn't my accountant look after that? And we sort of play second fiddle to the accountant. The accountants, they prepare your tax returns. We're just the people that go out and get the depreciation deductions through the depreciation schedule. So they'll recommend that you get a depreciation schedule. We'll head out and go and maximise those deductions for that particular component. Is the property too old? It can be. So if it's over 40 years, so 1987 is the cut-off date. There's some weird legislative reasons there, but 40 years, we'll just say, or 1987. If nothing's been done to that property, then it's exhausted its depreciation potential. However, we find quite significant deductions for properties that are older than that. And the reason being is renovations have been undertaken, whether or not they've been undertaken by you or the previous owner. As long as they've been undertaken within the last sort of 1990s, then we can claim deductions on those renovations as well. So if you think about inner city, so you've got Clifton Hill, your Carltons, you've got 200-year-old buildings there, but people are spending hundreds and hundreds of thousands of dollars doing renovations on those properties, and we're finding large deductions there available to them as well. Common areas. So if you buy an apartment in a block of flats, there's common items in that building. So things like the basement car park, the foyer, the fire services, all the sprinklers and hoses and whatnot. You own a percentage of that depending on your strata entitlement, and we can claim those as well. Can accelerate your deductions as well. And we've got furniture. So popular these days is Airbnbs. If you're planning on buying a property, renting it out as a holiday rental and using it yourself, as long as the furniture is new, we'll be able to get depreciation on that. And is it ever too late to claim depreciation? So if this is the first time you're hearing about depreciation and you've already got a property, Merry Christmas. You can go back at least 2 financial years and get those deductions back. I once was doing an inspection on a commercial property. It was a $20 million commercial build. We're talking large cool rooms that trucks can drive through. There was 3 stories of offices, and it's going to take me hours to do this inspection, and I'm walking around with the client. And just to make small talk, I asked him, Oh, how long have you owned this property for? And his face dropped. Well, no, his face didn't drop at this point. He said, 10 years. His face dropped when I asked him, why am I here today? And the reason being, his father-in-law had been doing his taxes, and he'd recently retired and moved to a home, and he found a new accountant that told him about depreciation. Now, he can go back at least 2 years. He can probably go back 4. But there's 6 years worth of deductions that he's missed out on a $20 million property. So we're talking conservatively $5 million worth of deductions he'll never be able to get his hands on. And I can only imagine how Christmas was that year around the table there. It'd been quite awkward. I'll sort of speed through this part, but My BMT is the portal we use, so you can get all sorts of different tools and apps and so on through that. You can track your depreciation schedules, you can add expenses and so on. You can share it with your accountant just to make it a little bit more of a one-stop shop so that you can track your investment there. You can find out the cash flow situation, not just for depreciation, but for all the components that go into it. So any maintenance that you do, add additions, when you pull things out of it, you can also change it. So we'll just go through that. That's fine. Yep. PropCalc's another tool we have. I will just point out that this is like a handy tool. It's like a real cost generator. So instead of just the bank interest that you might find from your loan, working out calculations, you can also throw in things like your strata fees, your management fees, taxes, and all those sorts of things. And compare properties side by side. So if you're looking to purchase a property, you can compare a couple of properties side by side with all the details entered into. There's research insights in there as well. So you've got sort of rental yield growth over time, and value as well. You can find out the property's value change over time as well. The process is simple. There's only 4 coloured slides. We work out whether or not it's going to be worth it. We'll speak with you about the property to make sure it's going to achieve enough depreciation to make it worthwhile getting done. We'll go and do an inspection. We produce a report in 5 to 7 working days, and then you've got that report for 40 years. We don't need to go there every year. It's just a once-off tax deductible fee that we charge you, and on your way you go. You won't need to have us back unless you decide to do major renovations, knock down, rebuild, so we can get those scrapping dollars. Pretty much. We're Australia-wide, and I'm a site inspector and I like travelling. If you have a property anywhere, you decide to invest in Queensland, Western Australia, in one of the various islands off the coast, we'll have a site inspector out there to make sure that we can maximise those deductions. Thank you very much.
Thanks for joining us on the Down to Finance podcast. If you enjoyed this episode, follow along on socials and hit subscribe so you're always up to date. Just remember, nothing you hear here is personal advice. Everyone's circumstances are different, so have a chat with your broker or financial advisor before making any moves. And if you're unsure where to start, Future Finance Group is here to help you map out the right path. Catch you on the next episode. Thanks so much for listening.